Welcome back to another video, everyone. This is the third and final episode of the Candlesticks series, and in this video I'm going to be covering pretty much everything else you need to know of candlesticks, including pin bars, engulfings, and more importantly a summary of the 3 videos and a real big key takeaway from everything. So grab that notebook and that pen and let's jump straight into the video. Right, so I have gold in front of us. Gold is one of my favorites, as well as one of the most traded CFD pairs out there. That's a fun fact for everyone listening. So in this video, I'm going to cover pin bars. I'm going to cover shooting stars, hammer candlesticks, engulfings, everything that wraps up candlesticks, pretty much just as a summary and a foundation phase. If you are new and you're starting out, I feel that is something that you need to know. Just as a bit of a disclaimer for everyone, it is important to know that candlesticks simply represent volume. If you have a bullish, meaning a positive candle, in my charts they blue, but ideally a green candle, you are looking for buying pressure. That's all it's showing you. If you have a very red candle, or in my charts, or the black candle, shows you a lot of selling pressure. That's all it is. Candlesticks literally represent how much buyers and how much sellers are in the market at that given time that the candle is printed. Wicks show you where the volume and momentum has been, more than likely where rejection has taken place, where there's buy orders, sell orders, and where the market doesn't want to be. So just keep those things in mind. So just briefly to reiterate, candles represent the volume of what is happening in the market at that given time. So it is quite important to understand what is priced into a currency. So as a trader, you can look for risk reward and jump on the back of it, and that should be your focus. So running through gold, I'm going to cover a very, very quick summary on an engulfing. An engulfing is when a candle gets printed larger than the previous candle that was previously priced in and printed. So in this example over here, you can see, let me get rid of my crosshair for a second. You can see that this bearish candle that we have here on the lows got engulfed, right? And the key takeaway from an engulfing is really to look at where something is, right? So if you look at gold over here, we do have a very key area of support where the market keeps bouncing off of. So it keeps coming to this price and keeps rejecting out of that. What you are looking for when you are looking for an engulfing, and this is a pin bar engulfing, so a hammer, meaning the market was at the low, right? And managed to have all this buying pressure and close up at the high. So just to reiterate that briefly, the market opened on the left. It had the low, right? It had the high, and it closed over there on the right before the next candle absolutely surged. And I personally love looking at the volume of a candlestick on the weekly time frame, because that then shows you what happened on that trading week, because then you have a very high probability in terms of technical analysis to jump in that direction on your next trading week from a high or a low once the market retraces and corrects. So in this case over here, we had a nice little engulfing. So all an engulfing candle is when the candle that prints is bigger and larger than the previous one. And in terms of volume, that just shows us there's a lot more buying pressure in this example. So a nice little hammer engulfing Marubozu closure. All that a Marubozu closure is there's no wick. So it had this massive buying pressure right till the close. And then you have that continuation on the next trading candle. In terms of a hammer, I've showed you a hammer. I'd like to show you just a shooting star. A shooting star is a candle that is very, very similar to a hammer. However, it's just the inverse. A shooting star has this massive wick to the upside and a very aggressive bearish body to the downside. So a beautiful example of a shooting star over here, simply a wick to the upside. Let's move that slightly. A wick to the upside, right? And this massive bearish candle thereafter. You usually tend to have some bearish selling pressure afterwards upon a correction. As I mentioned, you're looking for the reversal, you're looking for the correction before the continuation in that direction. That is something I'm going to bring on further videos. I'm glad you're enjoying this video so far. Don't forget to click the link in the description below. Join my Discord. There will be an option to upgrade the Discord to have access to full live sessions with me every single morning, along with a community of traders worldwide. I look forward to seeing you in there. Enjoy the rest of the video. But just briefly to reiterate, that a shooting star, right, has very similar characteristics to a hammer. You have the wick to the downside or the wick to the upside, which shows you where price has been. And more importantly, what we're trying to learn from that is the market didn't like it at that area, and you had those opposite orders coming in. So if you had the wick to the downside, you had loads of buys to push price to the upside. And if you had a wick to the upside, that means there were loads of sell orders over there pushing the market to the downside. So definitely something to factor in and to just keep in mind. So to briefly reiterate, you really want to just factor in what the market is showing you in terms of volume, i.e. when we're in a downtrend, you are looking for short positions and you are literally looking to sell the rallies out of areas of interest. However, you are looking for volume on the higher time frame to run in line with that on the lower time frame. So to briefly reiterate over here, for example, if we were to use this example down here of gold, you had this nice little hammer bullish engulfing pin bar engulfing the prior 2 trading weeks, right? Massive level of support where the market kept bouncing, which is this area of around 1650. If you then go to the lower time frame, your whole objective, right, should be looking for that break of structure, looking for buying from the lowest possible place. That's what you're doing, right? And very similar to the example I showed you on the video I just shot. So when you're watching this, it'll be video number 2. Was literally, I think it was GBP USD at the time, where we had the breakout, the retest, and gold's the same thing, right? You are simply then looking, if you are looking on the weekly time frame and the higher time frames, you're looking for that continuation on the lower time frames. And I will get into structure further down this beginner series that I am recording. And it's just something that will give you a bit of a foundation phase for what you're actually looking for. So on the weekly time frame, all you would have seen was we opened on the left, we had the weekly low, we had the weekly high, and it printed what you see on the weekly time frame as the hammer, right? That pin bar to the downside. And pin bars are relatively long wicks, and you tend to have that follow through to the upside. So if you look at this over here, beautiful hammer, pin bar, rejection, you tend to have that follow through in the next couple of trading weeks before we run straight into a level of resistance and we reverse. Equally so, same thing down here. The market prints a nice little hammer, pin bar, and then all you're doing on the next trading week, let's go ahead and dissect that together. All you're doing on the next trading week is you're looking for long positions, right? That's all you're doing. And if you go ahead and you really dissect that, what is the market doing? The market is then simply, creating a new high when the market made a higher high over there. And then the market is creating literally higher highs, higher lows before making new highs. What you really want to have a key takeaway from all of this is once the market has that bullish reversal, your job is to buy low on every little correction that we have. And that is a very simple term or very simple way of understanding candlesticks. You want to use the higher time frames to understand the volume. Your job as a trader then on the next trading week is to jump on the back of that. Carry on jumping on the back of that. Obviously looking for a good risk reward every single time because risk management is paramount to everything that you do. You want to go ahead and then look for those rallies in terms of volume. So on the higher time frame, right, we'll go back to the weekly. Equally so, and I'll show you the shooting star example shortly. When you are then looking for, in terms of selling off of a shooting star, in this example, we had a nice little break of structure to the downside, which I'll get to further in the series. But for now, before I even get to that, I think it's very important that you understand the volume of a candlestick, what is actually happening when you see a candlestick, and that will then give you more context on the further videos that I have planned in this beginner series. So looking at that, we had a weekly shooting star, which is a bearish reversal, right? Our job then is to look for that continuation in that direction, which is to the downside. So I'll leave this circle here just for you to remember this was the shooting star. The market opened on the left, had the massive rally, and then we had that decline. So you had the wick to the upside. Market didn't like it up there, so loads of selling pressure, massive shoot to the downside, and then obviously you're looking for that continuation in that direction. And truth behold, all that the market then does is creates lower lows and lower highs, and it is as easy, or it should be as easy as that. Your objective, folks, is to sell the rallies, right? Your objective is to sell the rallies, and that can be used with Fibonacci, which is something I'm going to be dissecting a little bit more into further detail. But your objective as a trader should be to run in line with that higher time frame. So the weekly candlestick, in my opinion, is probably the most important candlestick in terms of day trading, swing trading, because that gives you the direction of where something is priced into. Your job is then look for the risk reward to simply jump on the back of that. So a nice little bullish and bearish example over there on gold. This can be used on any time frame or any currency pair, excuse me. I would highly recommend it to keep it on the weekly and the daily to give you that overall direction of what was previously priced in. Your job is to look for the structure, to look for fibs, to look for risk reward, key areas of support and resistance, and I'll be dissecting macros in a further video. But just in terms of basic technical analysis, this does really show us what's priced in and what you need to do on your next trading week. Your job is to simply jump on the back of what has been priced in. And that's pretty much what I would class and summarize as a result of candlesticks. So just to remind you, we had dojis, which are small, very thin volume candles, right? We had morning stars, evening stars, which is the 3 candles, which prints the full reversal on the higher time frames. And then you got your pin bars. You got hammers, you got shooting stars, which show us that full rejection, either from the high or from the low. And then you have on each one of those examples, you're looking for the continuation in that direction on the lower time frames. But please remember, you want to use these on the higher time frames. They are really, really key. That is really a key part of understanding the candlesticks and understanding what is truly priced in. So the higher time frames, really want to dissect into what was previously priced in and then simply to jump on the back of that. But in terms of candlesticks, I think I've pretty much covered it in the 3 videos. If you haven't, go watch the other 2 to make part of the 3 videos of the candlestick series. And then I'm going to dissect more as we go on in terms of the basics. I think there is a lot to cover in terms of what you have to know. There is a lot of information out there, but for someone starting out, I think it's like building a house. If you don't build that foundation first, you're not really going to be around for very long. So candlesticks, that pretty much wraps it up. If you have any questions, drop it in the comment section below. Other than that, this is the end of the 3rd video. Go ahead and enjoy, make some notes, and stay tuned for the rest of the series. Thanks.